Welcome to the Healthy and Wealthy Retirement, where your certified retirement counselor Mark Struthers takes a holistic approach to retirement, going beyond finances and embracing holistic well-being. This YouTube channel will address not just the financial part of retirement, but also the social, the physical, and the emotional parts of retirement. Everything you need for a healthier, a wealthier, and a happier retirement. Here is your host, Mark Struthers.
Hi, welcome to the Healthy and Wealthy Retirement. My name is Mark Struthers. I'm your host. We're going to talk about the crash on August 5th, the crash today, Monday. And we saw quite a drop in every index. It was, they used the word bloodbath. There was a lot of red on the screen. We're going to talk about why that happened. It was a little something called the Japanese carry trade. And my assistant just flashed up the graphic he's going to use. And I think we're going to rebound from this. I hope it's not too soon, but it's someone pretending that they're hallucinated about the Japanese carry trade. Is it in the room with you right now? But we're going to put that up there. Hopefully it has some humor. Hopefully this isn't the start of something more severe, temporary but severe. So what is the Japanese carry trade? What can you do about it? Why is it affecting you? Recently, the rising yen, the cost to borrow yens has risen. It used to be really basically zero. And you had hedge funds mostly would borrow at zero, free money, kind of like we were a few years ago. And they would take that free money and invest in things that could make them a lot more money, like certainly some bonds you could bring in the U.S. Now, you have exchange rate issues, and that plays into this as well. Because in this case, the yen went up in value and rates were increasing, so the cost of them bringing the money back to Japan, the yen, was getting more expensive. But I don't want to make this too complicated. Bottom line is they were borrowing really cheap money from Japan and investing in other places, including risky assets like the U.S. and I think Australia was hurt even more. And as they had to unwind this leverage, they had to sell what they could. So that's the Japanese carry trade. I think that's put as simply as possible. Otherwise, there's a little more nuance, but that's it. And that's the main reason of what's caused this. We saw last Wednesday when Powell from the Fed spoke and it was clear rates were going to go down, the market shot up. I mean, a lot of volatility. In the short term, we expect that. I mean, if you own equities, you know you're invested for the long term. You know that this is usually at least money that you're not touching for 2 or 3, but really 3 to 5 years. And we even think longer term than that. But that being said, you can't help but pay attention to the volatility, and especially if you do need to access this money sooner than, especially within a year or two, but even 2 or 3. So you saw that, but then you saw that we had a weaker than expected jobs report. Still positive. It was only 1 month. So that was a concern as well. Also, you had some ongoing issues with tech companies. Their valuations have gotten real high. Most of our indexes, like the S&P 500, are very concentrated in these large tech companies. So the question on the return of their investment in artificial intelligence, which their investment is somewhat recent, but you never can tell when the market's going to say, we need to see, if we're going to give you this premium, we need to see something on it. Also, when you kind of have things that are pretty pricey, probably not the rest of the market, but for the tech companies and especially the top 7, and anything can kind of disrupt it. So sometimes it's just bad luck or timing, and things can cascade. So you can have something, and you kind of saw it in the housing crisis. if the U.S. government and Fed had done just a bailed out, maybe Lehman Brothers had done a couple things differently that they started doing anyway, you could have maybe prolonged things long enough to where things could have normalized. So especially anytime you get richer valuations or you have things that are kind of priced to perfection, then you have something like this where there's, in this case, really kind of, there's always leverage in the market. And some of that's good. It's a way of us adjusting currencies, arbitraging. It's a way of finding a real price for things. So some of this is not horrible, but when you have this much leverage and no one really kind of saw it, no one really knew. I don't know, even those who Monday morning quarterback, no one said, yeah, I thought something like this was coming. And I listened to business radio all day long, and I never heard anyone mention it. So, but when you have this when things are kind of priced to perfection, and you have the timing of albeit just one, there's still a lot of some real good earnings out there. Still a lot of green shoots, so I don't want to use the word shoots, but still a lot of positive things that say a soft landing or something like it could still happen. But when you had this all at once and things priced to perfection, and sometimes when you have these disruptions, if there is something else out there that would have been ignored, that would have been able to function and move on, and if there was some sort of issue, resolve it, or kind of maybe say a company or dissolve quietly, this uncovers it. You saw it with the financial crisis. It's that all of a sudden some of these companies that probably should have gone out of business years ago, all of a sudden came to light. And Bernie Madoff, that comes to mind. Think how long he went on, and it wasn't until you had the financial crisis that he was no longer able to keep the shell game going. So there you have it. That's what happened. And the question is, what can you do about it? Well, first of all, don't panic. You can already, is it possible, again, if this uncovers other weaknesses or just bad luck, bad timing, it could cause other issues. But in all likelihood, if this is just it, there's still a lot of, again, good stuff out there. And even if there's not, you stick to your plan. So you don't panic. It's why you diversify. It's why you have an emergency fund. So an emergency fund is always understated, and people kind of roll their eyes when I say it, but quite often when I see people come to me, and when I used to do employee well-being and I was speaking to a dozen or two employees a week, you'd be surprised, even with all these seminars, how often they did not have an emergency fund. Quite often they had some of them were living paycheck to paycheck, and some part of that's a budgeting issue. But some of them had the assets; they just didn't have an emergency fund. So I'm a big emergency fund fan, especially when cash-like rates are higher. But I also think that if any sort of yield or return that you're losing on your cash, and sometimes it does go too far for folks, but if it even just keeps you from panicking, it allows you to sleep at night, it allows you not to panic and sell, it allows you to take on a little more risk, longer term you're going to be better off. So the other thing you could do is take a closer look at your bonds in your portfolio, the fixed income, the ballast. You might want to start to go longer duration, because in all likelihood, again, with bonds, we never know for sure, but in all likelihood, if we get a flight to safety, and you saw it Friday and Monday, you're going to see bonds do well. People are going to, in the U.S. is still the best looking house on we'll call it a bad neighborhood, but because other countries are most often in worse shape than we are. You're probably going to see a flight to safety. Now, again, what they call the shorter end of the curve, so especially 6 months to 2 years, those have been yielding a lot. That's where the Fed, when it does its thing, has the most impact. Our yield curve, to get technical, is inverted, so things that you get paid less for locking up your money for 10 years than you do for 2. It's been that way for a while. Not always a harbinger of recession, but quite often it is. But it's a good time to take a look there. And also you have reinvestment risk. So if we do get a downturn, it might be worth giving up that 5% return for 4%. I know it's not quite there now. It's been bouncing close to there. 4% on the 10 years. So because when those bonds mature, if rates do go down, then you might not be able to reinvest them for another 2 years at 5%. You might have to take on more duration, and it's better to take on the duration to get the yield when you have control and you can coordinate it with other things, like your emergency fund. So there you have it. Japan's causing some issues. It hasn't caused this many issues since the explosion at Nakatomi Plaza in Die Hard. Whenever I think about Japan, well, I think about World War II, obviously. I can't think of the red color expanding on the map. But I also think about Nakatomi Plaza. That was kind of the height of Japan's economic power in 1990, I think, where that was, in many ways, that signified the Japan taking a downturn, I guess. That's where Japan kind of had its lost decade or two, where they were the envy of the world, and things changed a little bit. So, but if you do those things, stick to your plan, don't panic, have an emergency fund to help you not panic, take away some of the anxiety, to review the bond, how long the maturity is on your bonds in your portfolio. And if you do those things, you're probably going to have a healthier, a wealthier, and a happier retirement. Don't forget to hit subscribe.